All right, so why don't we get going? A couple minutes after. And so this is welcome. Good afternoon, good morning, good evening, or good night, depending on where you are. Today we're going to talk about financial services. So this is going to be the first webinar of 23, deep diving into some specifics on financial services and the trends report. So a little bit about FTI at first, up front, is kind of the methodology that we go around. We track signals and trends, and this helps us understand what's influencing the future. And that leads into these macro scenarios of what are the futures. So not just one, but plural of all the different futures going on. And then that leads into strategic scenarios, and that's really about what's your organization's future. And so this report is part of that signals and trends, that kind of upfront, what's happening, what's the research showing, and what's kind of going out across the whole sector. So framed in a different way, the methodology here is about convergence and divergence, where it goes big to small, big to small, big to small, where you get all the way to the end, where you have actioning and where you're really making decisions and making changes based on what's coming in the future. So FTI, Future Today Institute, is a management consultancy, and here's a selection of the clients that we work with, that we've spent a lot of fun time thinking about the future and what's going on and helping them prepare for it. But let's dive in. So this is the cover for this year's 2023 Tech Trends Report. This is part of a very large, by the numbers here, report, which has 666 trends, has 15 sections, 800 pages, and it's the 16th anniversary. So we're projecting about 1.2 million downloads. So it's part of a very extensive report. And so we like doing these deep dive webinars to go through and think through a little bit more in detail on specific industries and where the questions are, because it's a lot of pages to read. And so we really want to help you understand what it is, and so you can best use it. So this is part of a selection, QR code to sign up for more of the trends. Some housekeeping, I believe, would probably be a good thing here. We're using a question and answer form in Zoom, so please go in and write any questions you have. We're going to try and spend some time at the end answering those questions and going through it and make it a discourse and a dialogue and sort of really a back and forth and answer the questions that you have. So intro on me. My name is Kriffy Perez. I'm a senior expert advisor at FTI. So that means that I get pulled in for specific subject matter expertise around financial services. I'm also a managing partner at Global Paytech Ventures, which is a venture capital company that invests specifically and exclusively in payments and payments infrastructure. I'm a recovering management consultant. So that means I spent almost 10 years in MasterCard's consulting group. And I've been in the payments industry and the payments space and financial services for almost 20 years at this point. And the reason why sort of recovery management consultant is on there is, as you'll see going through these slides in this presentation, I like a lot of mental models and frameworks. I think part of the structure of this presentation and the structure of this book this year was really to help people navigate financial services, navigate the complexity, and sort of throughout my career, what were the aha moments and what were those nuggets that helped me understand what was happening and really get at those kind of first principles, base order components of financial services. And so all that adds up to also, I spent a lot of time in management consultant, but also innovation. And so part of that is I've filed 15 plus patents on financial services and usually using transaction data to implement new experiences. So that's a little bit about me. What's our plan for today? What are we going to spend the next little bit of time going through? So kind of in that flaring and compressing and going narrower than wider, we're going to start kind of going wide, talking a little bit about mental models. This is what I've found really helps, especially with the students that we teach at NYU's MBA program. Helps them kind of get a baseline of what's going on in financial services to understand the nuance and sort of helps them teach themselves. Then we're going to go into the trend clusters. So they're kind of the groupings that you'll see in the table of contents on the report. There I'll talk a little bit about kind of what's the key aha kind of those little sections at a very high level. just so we can kind of understand what's going on, so that you guys can read through in detail and find for each trend and each page, there's kind of an aha that I've seen throughout my career that goes in there, either from where very early or going more future in my career and kind of what's coming down the path. But I think the point of it was all to be helpful for people of varying levels of expertise. And then we'll finish with a little kind of overview of how to prepare from a couple different viewpoints and a couple different insights, like the one thing to remember, and we'll end with opening it up for questions. So that's the general flow. I guess cries of outrage, throw in the comments and the Q&A. We have a colleague of mine, Melanie, who's going to be helping us moderate and drive the Q&A and basically MC and help with any issues that come up. So without further ado, let's dive in to the first mental model, which is frameworks. And this is the two-party model, right? This is often called bartering and trading, right? And so this is one of the foundational components of financial services and banking, right? It's, for example, you got Lance on the left, who's a consumer, to use kind of the Google key term search terminology. He has milk, and then he wants to have some cookies. And so maybe Alfredo is a person or a merchant who has cookies. And so they're trying to make a transaction. They're trying to make a trade. And so he's like, what about if I give you some milk, can I have some cookies? But Alfredo says, no, I can't, because I don't want your milk. And so that's where there's an impasse. And that's where the two-party model starts to fall apart, right? You can't trade milk for milk. You can't trade chicken for eggs. You have to have both parties want it. And so that's where you enter money. This is where you add in something that enables that transaction to go more smoothly. This is, if you're going to Google search it, the key term's kind of currency, but the idea around is money and currency, right? And there's two components to currency that are really kind of the base building blocks. And one is the trust that you can use that for something else in exchange, right? So if I'm going to give you milk, you'll be able to get cookies, or if I'm going to give you eggs, you'll be able to get milk, chickens, or some, there'll be a transaction able to happen. And then you also have faith that it'll be worth what you want when you want to use it. And so that's sort of the volatility component of it. And that's something where you also see where if you're looking at crypto and you're looking at the decentralized finance space, the definition of currency is sort of debatable for whether there's parts of Bitcoin and things that are there yet. But these are the kind of the two main tenets of money, right? It could be a diamond, it could be a currency, it could be a coin, it could be gold bullion. It could be any sort of thing that facilitates that transaction. And so adding in money then makes the two-party model into a four-party model. And this is kind of the framework of and the mental model for what most all financial services is now, right? So this is the basis of especially the payment system, but this is the basis of financial services. You've got a consumer all the way on the left, Lance, who typically has a money or $2 bill or something. Then you have the person that facilitates that money. So that you have Lance's bank, often called an issuer. That usually in today and age looks like they give you a piece of plastic that's like a debit card or a credit card that gives you access to that account. So Lance's $2 is placed in that bank. Then you've got the networks that communicate in the middle. That's the Visas and the MasterCards that communicate to the other side, which is like Alfredo, who's got goods and services, presents, milk, cookies, etc., that he wants to sell. He needs a bank that manages his money and manages his interests. And so that's usually called the acquirer. That's the merchant's bank. And that's often, you can see it visibly as the point of sale terminal at the bottom of the screen there, right? That's kind of the personal embodiment of that, allowing Alfredo to accept various forms of payment, different types of things, not just cookies that he trades in. And so this is the four-party model. Now, a lot of people you can kind of add nuance and flavor to it, and there's a bunch of different names and different analogies and different systems. But in the end of the day, this kind of boils down to the basis of what is the building blocks of financial services. You've got a consumer on one end, you've got a merchant on the other end, and then you've got a couple middle players, people in the middle, helping make those transactions happen, helping the money change from one place to another. And so you've got the bank that has the merchant's interests at heart, and then you've got the bank that has the consumer's interests at heart, and then you've got the people that talk to each other and make that happen in the middle, the Visas and the MasterCards of the world. So that's the four-party model. That's sort of the basis of financial services. That's kind of, if you're going to oversimplify to the 1 million, not the 30,000 foot view, but the 100,000 foot view, what's going on. I like to use this because it helps to understand what are the main needs, what are they trying to solve for, what are they looking for, and what are they trying to do. The other framework that we use a lot, and the other mental model, is money at rest versus money in motion. And so this is really around what can money do, right? What can currency do? What can a store of value do? And it's kind of in a couple different phases, sort of phase change, to overuse the sort of the physics, mechanical engineering analogies. But if you go all the way to the left, you're looking at money at rest, right? So money that's not moving and you just want to put it in one place. That's kind of the piggy bank use case, right? That's the needs of the money or the end consumer, and that's holding the money. That's typically your retail bank, right? There's some logos down there, so you see Chase, Bank of America, Wells Fargo. This is retail banks, right? As a consumer, as a person, or as a function, as kind of a base need for what you want there, you're trying to have your money somewhere really safe that you can get to it whenever you want, and you want it to be stored, and you want it to be kind of stable. So that's your like retail deposit. Then, so if your money's getting held somewhere and just kind of camped out, then the next thing you might want to do with it is allocate it, right? You might want to make it work for you while it sits there. And that's where you enter the investment banking kind of universe, the JP Morgans, the Goldman Sachs, the Morgan Stanleys. So that's the money at rest side. This is kind of an interesting thing because the relationship between holding money and allocating money, if you've been watching the news the last week or two, has been crazy with Silicon Valley Bank, right? Because part of it is you're a retail bank, you're supposed to hold the money, so you need to manage a balance sheet. But at the same point, our banking system works on a fractional reserve banking system, which is you can then allocate the money, right? And that's core to capitalism. It's core to what makes our economy so powerful, is because, 1 to 10, right? You take $1 in, and then you can loan that same dollar out 10 times. That mechanism is what drives economic growth. That's what allows the money multiplier effect to be so powerful. But it also means that it enables something like a bank run, where everybody tries to take their money out at once, but it's not all there for it to also collapse the system. So it's this fine balance between what does it mean to hold money versus what does it mean to allocate money. And I think that's why it's helpful to understand the money at rest and sort of what phase are you in and where are you kind of balancing or towing the line between one side and the other, and how do you kind of make sure your core kind of first principles are being met, right? It's easy to forget with so much that a bank needs to do. What part of the bank are you talking to? Are you part of the retail bank where their primary is to hold the money, or are you talking to the investing side where their primary is to make the money do things? So that's the money at rest. That's more of what people will traditionally think of when they think of financial services. And then there's sort of what's become the sexy or the new part that's surprising people, which is the money in motion side. And this is the whole component on the right, which the analogy is a bit of a highway, or kind of like waterfalls or electrons flowing down a pipe. Let's stick with a highway because I think it's a little easier for most people. But if you have an engineering background, you might think about the electrical engineering side of like electrons flowing down a pipe. But you have a highway, right? And so you got different components of the highway. If you're kind of in the middle and you're just on the highway and you're like the Visa or the MasterCard, you have a very particular base use case and need, right? You want to make the highway be able to carry as many people as possible, as many cars, as fast as they want, to wherever they want to go. And so your business model would make sense that you're a toll booth, right? As a toll booth, you don't care how big the trucks are, as long as the trucks can fit on the road and they can get from A to B, that's perfect for you. That's really beneficial. That sort of dictates what the business models around it are. And part of why MasterCard and Visa have such great valuations is because they're part of that highway. Now, to get to a highway, you also need to be able to get on and off the highways, right? This is especially pertinent in crypto space when you're trying to get into a cryptocurrency or out of a cryptocurrency. You need ramps that are on and off. Your average consumer sees this less. This is usually called acquirers. This is the Adyen, FIS, Fiservs of the world that kind of connect you to these networks of money moving. And so when you want money moving, you want it to make sure that it gets from A to B. You want to understand the speed. You want to understand how safe it is. It changes your perspective of what you want the money to do. And then the third is the ramp and highway, right? So this is more of just, there are entities that own the entire ecosystem, right? They own the way on, they own where you're going on the highway, and they own the way off. This is most easily explained to North Americans as a Venmo or a WeChat, which is you take money out of your checking account, you put it into Venmo, you then send it to peer-to-peer, you send it to people. They often keep the money within Venmo. They never take it out and they send it to somebody else. So you're all sitting inside the same ecosystem, but then eventually some people will take the money out back into their checking account. And that's where you'll see like an ACH transaction that'll take 3 to 5 days, that'll wire the money back out into that checking account. Or what's hopefully coming, it's just announced in July, I believe, is FedNow is going to accelerate that system. So you're going to be faster ways on and off. So that's the money in motion. That's the money at rest. I think this is just a really helpful analogy to understand what's going on. What are the use cases? What are the business models? What are they trying to achieve? And sort of dissect and distill what a lot of different people are doing in the financial services space and what is the kind of value they add, what's the need that they bring. I found this personally extremely helpful when trying to kind of navigate the cryptocurrency and DeFi space at the very early days of just like, what is it? What are they? What kind of frame of reference and what, where to look at. So I see no comments or cries of outrage yet, so we will continue and we'll look into some of the trends. So the first trends cluster is open banking. What is open banking is sort of the first question. This is the easiest example is PSD2, so Payment Service Directive 2 coming out of Europe, which is enabling bank ledger access. In essence, what that means is your bank keeps a ledger of credits and debits, sorry, and kind of keeps a record of how much money you have in there, how much goes in and how much goes out, right? That ledger historically has been completely private, right? Only the bank has access to that. And sometimes you have access, but sometimes it's limited access to even viewing it. What PSD2 is doing and what open banking across the world is doing, and it's at different stages, is allowing access to that ledger, allowing access to that financial services information to understand what's behind there, right? What did you buy, when, how much money do you have, how much is coming in, how much is going out, all of the information and analysis that you can do around that. So all of the things like alternative credit scoring, increasing financial service, people that can be partake in financial services, creating that whole ecosystem. Now, there are a couple different components to that. One is just read access, right? And so that's what we're starting to see a lot of the excitement around. It's just all of the startups and all of the different things that you can do with this really rich data. PSD2 is doing that. You're starting to see open banking. You see Plaid in the US. You see a lot of different players enabling that. But then there's also the component that often gets forgotten, which is sort of the right access, right? The ability to do something about that. It's one thing to be able to see what's going on behind the scenes and what's happening in all of your historical data or your current data. It's another thing to be able to make changes to it, to actually initiate a payment, initiate a transaction, initiate a difference, right? Create a credit, create a debit on that ledger. And that's where we're starting to see even more activity coming and sort of more of that future innovation and startups interacting. So I think open banking is that first most important thing. It's a trend that's been around for 10 or 15 years. It's taken a long time to come to fruition, but we're starting to see the fruits of that labor. right? And you start to see it from kind of two opposing axes or entry points, right? You've got the free market approach, which is more of the US approach, where Plaid and you've got specific players creating this ecosystem. And then you've got a little bit more of a regulatory approach where regulators are mandating to enable this access, kind of like the European Union with PSD2, enabling that access and kind of creating the space for all this innovation to happen. So that's the open banking. I think that's the number one. That's the big starting point. So number two, what you start to see and what's starting to happen around this and kind of another cluster of trends that you're seeing is invisible banking. And what we mean by invisible banking is really around the commoditization of banking infrastructure. So all of the things that happen in the back end are becoming commoditized, right? So they're not becoming a brand preference issue, the way that Visa versus MasterCard historically was a brand preference issue. It's becoming more of a systems issue of just what's the right system for the right solution at the right time. And so it's becoming more interchangeable. It's becoming less of a thought out customer action or a decision. And so part of that is this concept of card on file and platform players and the relationship that platform players have on with card on file. And what is that? What that means is, when people think of the Uber of X or part of just being Uber, part of what helped Uber and a lot of these platforms accelerate their growth was the fact that the payment system was embedded in their user experience. So they were able to create experiences where, if you use Uber as an example, just booking the cab, booking the taxi, pre-authorized the transaction so that you didn't have to have a new friction point when you're exiting the taxi. And so this is a bit of a dirty little secret that a lot of these platform players, part of what's allowed them to accelerate and what allowed them to kind of create such magical customer experiences and really drive adoption, was this card on file mechanism. Now, card on file traditionally just means that your card number is saved, but this is changing entirely, and kind of depending on how futurist you want to go, you can sub in whatever name you want. Token on file, crypto on file, signature on file, identity on file. The real concept here is that it's pre-authorized and it's pre-enabled to happen outside of the moment that you're typically making a transaction. So it's kind of like the beginning of embedded finance, but it's really the beginning of these like magical user experiences where you're separating the thought of payment from the moment of payment, which makes it even easier to commoditize how the systems get done on the back end. Because you're just sitting there saying, I need a taxi, not, okay, I'm in a taxi, I need to get out now. How do I pay this person? Do I pay with a card? Do I pay with cash? Do I have change? What do they accept? What do they not? So that's kind of a fun, dirty little secret or an aha moment of like, yes, part of what makes Amazon so successful is that they have your payment credentials on file. So it makes it a lot easier to buy more on Amazon than you would otherwise, right? Part of why Uber was such a great experience is that card is on file so that you don't have to take out a card or a piece of plastic and haggle or negotiate with a taxi driver on the exit of the ride. You can just get out and keep going. So now that we've kind of gone narrow, we're actually going to go broader again, which is sort of a strange way, but talk about building blocks all of a sudden. But I think it's helpful to sort of, we went a little bit narrow, now we're going to go a little bit wider and be like, but wait a minute, why, like, what is going on here? And why is payments kind of, and financial services touch so many different things, right? And so payments is key to value exchanges, right? And so part of this is that payments and financial services is a building block to a lot of other experiences and a lot of other systems, not just in virtual sense or in the virtual space, but also in the physical space. And so I'm going to throw another framework in here. But what the concept here is around the value stick, right? And so I use this concept to help understand why financial services can be so broad and fintech can be so diverse and so dynamic and so complex, right? And part of that is this one mechanism, right? Which is, I find, well described by the value stick, even though the value stick's not always the most intuitive system. But what the value stick's trying to say is that in a capitalist environment where a corporation is designed to create value, they've got kind of like a stick on the left side that you see where they take in costs, so they take in raw materials, and then they mix it all together to create something, right? And that's the total stick, the whole thing. And that's the value that the seller created. So they take something in, they mix it up. So say it's like ingredients, they're baking bread. They take in all the raw ingredients, they put it all together, they mix it, they bake it, and then they create bread. Out comes bread at the end, and then they create all of this value by having something that's baked, it's warm, it's fresh, it's nutritious, and then how do they capture that value is by selling, right? So it's the only mechanism to actually turn this imaginary value into captured value is by having a purchase, is by having a price, is by setting that price. And setting that price is what differentiates what the buyer gets to receive as value of the bread, but then also the profit for the seller, what value they created. And so because price is the only mechanism that does this, and price can only be turned into reality by making a payment. Payment, by definition, is the only way for you to capture value. And so any company in any industry that's trying to create value needs to capture value. And the only mechanism for capturing value is by making a payment. Hence why payments and financial services ends up going across any and all industries, because that is the one way that you capture value. So that's why price and purchases and payments can be so diverse and so dynamic, because it has to solve for all of these different use cases and all of these different issues. And so that's why you see fintech sort of suddenly becoming really sexy, suddenly becoming something really interesting that has a lot of staying power and a lot of interesting financial models, is because that payment and because financial services is really key to value exchanges. And value exchanges is really almost synonymous with social interactions, because the vast majority of your social interactions is there's a give and a take, and maybe you're learning or exchanging goods or services or something. And so it becomes critical and core to all of the mechanisms for capitalism, but a lot of the mechanisms for social interaction to exist. And so that's why financial services ends up being a building block to a lot of other services and a lot of other systems and a lot of other industries. Now, digital identity is the root topology, so to speak, for financial services. So this is another reason why digital identity comes up a lot in the conversation around financial services, because it gets down to you need to identify whose account you're debiting and crediting, right? And what is that? And all of the information that goes with that really kind of ends up boiling down to digital ID, right? And so that's why digital ID becomes something that's really gaining momentum and becoming more and more interesting and more discussed from a financial services perspective, because financial services has used sort of, especially in the credit cards industry, your credit card number as that root identifier for a long time. But they're starting to see opportunity for that system or that root identifier to extend beyond just financial services into larger things like government, voting, and education, and kind of the entire digital space, where you sort of still need this root identifier. And so one of the other concepts that came up that I think is a good building block for financial services is that, you think of financial services as something that's wildly complex, and you can have all kinds of exotic products and systems and things, and shorts and puts and all of these other things. But in the end of the day, it boils down to really 7 uses. They offer a means to pay, save, borrow, lend, trade, invest, or insure against risk. So kind of out of all of that complexity, it really only boils down to 7 things. Now, 7 is a lot, and it can be a lot more than a lot of other industries, which is part of why it's so complex. But I think it's helpful to think back, well, what does this product do? What does it fit? How does it fit into that ecosystem? So the digital identity is a great segue into governance, right? So governance is a topic that we're going to cover a lot more tomorrow with decentralized finance. But the key insight here is that it could help usher in the next form of democracy, right? All of the governance systems that you have in decentralized finance could be a great proving ground for how do we vote, how do we identify people, how do we continue to evolve our forms of discourse. And so flaring out and kind of going further into the last topic that we have for here is new forms of income. And so some of this concept is around passive income, kind of changing into the concept of being a time millionaire, right? So it's this evolving idea that you make income as a means to have enough passive income to not have to work in a traditional sense, right? So you're financially free and independent so you do what you want, when you want, how you want, which makes you a time millionaire, right? As opposed to trading X, 1 hour of work for X dollars or X value. You try and aggregate enough assets that generate enough passive income that you can then choose to work where and how you want. And so this I find really interesting as it's changing the evolution of retirement and what people are working towards and what they are saving towards and what they're building towards. I think this is a very interesting evolution as we go with younger generations and kind of as the demographics of our society change. The other part of this sort of new income is part of the funding mechanism system. And this is a little bit more particular to venture capital, but the path to the initial public offering or the IPO going to the public markets is changing, right? It's not as desirable or it's not as common as it once was, which is changing a little bit of how the macroeconomics work of how can the rest of society partake or have a winning share of all of the success that these companies are making and the value that these companies are creating, right? And so this is a little bit of like initial coin offerings, direct listings, staying private forever or for a longer period. And so all of this is changing kind of some of the base mechanisms of capitalism and our global economies and what is the purpose of our corporations and where do they head, right? And how do the most people partake in the benefits or the value that all of these different companies are creating? And so that's the trend clusters. So I was going to spend a few minutes just on kind of high level, what are the preparers from different perspectives. So if you're kind of a corporate innovator, now I think is a really important time to prepare for fast following, right? So figure out where people are innovating in your space, where are the startups, pick the winners, partner with them, try and build them in, try and integrate them into your existing systems, kind of start to look for where that is, right? If your regulators really is around creating the space for that innovation, whether that's being free market or by mandating rules, understanding where that innovation is, trying to foster it and trying to kind of continue to refresh those rules and those regulations to make sure that they're reaching those targets and keep those goals going. If you're a startup, you've been seeing the craziness and weathering the storm and all the changes in valuations in the public markets and in the private markets. So kind of the one-liner here is get to break even, make the proposal that gets to a realistic break even, and get your team, get your investors, get your systems on board for kind of battering the hatches and weathering that storm. As a venture capital, it means supporting that, right? So help them get to break even, help them build those plans, help the build gated budgets so that if things go well, we can ratchet up, but let's be prepared for the worst. And then what does preparing for the worst mean is really for those startups that are going to struggle or that are kind of going to need to roll out and wind down, help them unwind with dignity, right? Help people close with dignity in a way that's good for the environment. It's good for the different people that are working on it, good for the ecosystem. And then a last sort of thought for the retail investors is really this concept that there's a shift of reversion to value in unit economics. And so you're seeing less story stocks. And so be aware that you're seeing more and more people and more money flocking to the unit economics and the value, right? So if you have the numbers, so if you're a startup and you have the numbers, there's still capital out there, but you need to have the numbers. And so you need to kind of keep this constricted approach so that you can grow when you have the opportunity instead of putting yourself out there. So that's what I had prepared for our discussion. Put a QR code here for more events to sign up for more if anyone's interested. We're going to go through a lot more crazy fun topics, including decentralized finance tomorrow. And so the rest of the time I was going to leave open to questions to see if there was any questions that we could discuss, or any concepts that kind of needed more clarity, or you wanted to deep dive on anything from the trends report itself, and go from there. I don't see any questions at the moment. We'll give it a few minutes.
We had one come in from Melissa asking to talk about decentralized finance. We do have a full webinar scheduled for tomorrow on the topic of DeFi, but Griffey, is there anything quickly that you want to mention that pertains to some of the topics that you talked about today?
Sure, I'll give you the two thoughts, because I don't want to go into it because we're going to have the whole thing, but one of the ahas is the concept that central bank backed digital currency is a stable coin, and a stable coin is a peg, right? And so if you Google pegs have always been a precarious system in the past. They've essentially never worked because they're so hard to manage and maintain. But they're very, very important in developing and building the trust needed to move to a fiat currency or something that's not backed by like a gold standard or something specific. So central bank backed digital currencies and stable coins, I think, are really interesting in evolving and developing the future of decentralized finance, which I think was really interesting. And then there's just the concept of how far DeFi needs to grow, which is a lot of the layer 2 enablement that's coming, of building up the speed and the volume and the processing power to be able to replace or work in parallel with some of the existing ecosystems like Visa. Visa can process 24,000 transactions per second, but Bitcoin can only do like 2. Right. So people are enabling that. There's just a long way to go. And then, what is the price and what is the cost of doing a transaction on Bitcoin or on a cryptocurrency versus decentralized versus a traditional method? I think those are the two kind of main highlights for me of the ahas.
That's great. Thank you. Luis would like to know a little bit more about the difference between invisible banking and embedded finance.
Yeah, fantastic question. So I think invisible banking is the fact that it's all back office, right? It's that it's all hidden in the background. It's all systems and plumbing, so to speak. Embedded finance is really, for me, it's moving that purchase decision to a different place. So it's like, the example I like to give is that you get a car loan at your car dealership is essentially embedded finance, right? You're there at a dealership buying a car. Why are you getting a loan, right? Depending on where you live, a lot of places you get a loan at a bank branch. That's where you interact with financial services. That's where you get money that you then take to wherever you're going to make the purchase. This is also really common in mortgages, especially in Spain, where you can't get a mortgage at a realtor, right? You're not getting a mortgage on site when you're visiting a house. In the US, you can. So that's the beginning of embedded finance. And so what embedded finance, the real promise of embedded finance is just all of the other things you can do at that moment, right? It's not just buy now, pay later, where I can get a loan when I'm buying something online. It's all of those other 7 buckets that you can do.
Thank you.
Hopefully that answers that question.
Yeah, that's great. Any tips for established companies who are seeking out partnerships? What should they look for? What should they watch out for? Anything for more mature companies who want to partner in the space?
Yeah, that's a really, really good question. It's sort of, I think it depends what part you're in, if you're a bank or this or that, but like, let's try and do it at the 100,000 foot level. If you're a legacy embedded player, it's very important to understand what value you're bringing, what's kind of your core competency and core skill set, and then watching what are the startups out there that are not just, you know, proof of concept, but that are building scale, right? So you want to be able to pull in somebody who's had a proof of concept that is starting to build scale, where you can help them scale much faster and they can make sure that you stay pertinent. So the silly example that I'll give is Apple Pay, right? When Apple was developing Apple Pay, they could have decided to go a la WeChat and built their own payment system and ecosystem and infrastructure. They could have said, okay, we're going to hold the cash. We're then going to distribute it when we feel like it, how we feel like it, when we want. What was very intelligent about the legacy system, so to speak, or the MasterCards and the Visas of the world at the time, is they worked with Apple to make sure that the new system that they were building used the existing infrastructure, right? So that credit card was still the basis of that Apple Pay transaction, as opposed to, say, your cell phone number, right? Or have the telco be that root identifier or that root basis. So that's kind of an easy in hindsight, but in foresight, what you're looking for is parts where there's synergies in that, right? And synergies is such a consulting word, but where you can help each other, right? So if you're Apple Pay, you're looking to get as much scale as possible, as quick as possible. If you're a payment network, you're saying, I want to stay relevant, right? I don't want to be disintermediated. So how do I do that? Well, this guy who's coming along with a really wonderful customer experience, how do I make sure that my system is still part of that? And I'll pay for the development so that my system can work for their system. So that would be my answer for that.
Awesome. A different question, how is ESG affecting financial markets through regulations and disclosures, as well as investments themselves? Just a small, narrow question for you.
No, that's a good one. That's a good one. ESG is a very interesting space. And I think it's increasing massively in importance as people value it more, right? And I think part of valuing it more, and one of the trends that's contributing to this, is that people are trying to look at things in a more holistic way. And so the ex-CEO of MasterCard used to say, doing well by doing good, right? So doing your job, like, people are trying to have a longer term view to what they're doing and the benefits they're creating. And ESG is a mechanism to ensure that they are doing long-term good. Because if you're looking at something with a very short-term view, you almost always are looking purely at profit in like a quarter by quarter basis. But if you're looking at something that's in a longer term, multi-year threshold, you're looking at sustainable profit, right? And you're looking at profit that kind of comes at an equilibrium. And a big component of that equilibrium is the whole element of ESG. And it's one of our tools that we have today for how we take in all those externalities into making sure there's a solid ecosystem. So that's where I think ESG is coming in. And I think you see it in investing because it's a mechanism for making sure that people are having a long-term view and are trying to account for more than just short-term gain.
I'm going to skip to a recent question that just came in that's related. Any tips about consumer duty and future requests from regulators?
So
what data and information might we need to share in the future as a financial services company that we don't need to right now?
So what might we need to share? Okay, so consumer duty, I think, is really interesting. I think that kind of correlates to the vote with your wallet concept, which I think is one of the most powerful ways to instigate change and make change happen. Is a way that each of us as individuals can act on whatever our beliefs are. Is to sort of vote with your wallet, so to speak. So I think that's huge. Now, the second part of that question is, how does a regulator and what kind of stuff will financial services need to provide to allow more of those sort of, you could say ESG, but you could say kind of for the right reason purchases to happen in the future. I think a lot of that boils down to transparency, right? Open banking is starting to do that, where you kind of pull back the kimono, pull back the cape, the curtain, and you can sort of see what's happening in the back end. I think what that means is sort of the joke that we always give is just imagine, especially at the management committees, is imagine the headline, right? So if you're doing something slightly questionable, or you're doing something whatever that you have to think twice about, imagine the headline of what it's going to be, right? And so I think we're starting to come to terms with that as a total industry of like, everything we do isn't necessarily under that level of scrutiny, but we need to be prepared for it. We need to be okay. We need to be able to sleep with what happens, right? And so that's also kind of the like, assume you're going to get audited by the IRS for your taxes and act accordingly. And so if you assume that, then if it happens, then it's fine. So it's kind of, I think what that mechanism is assume that people will be able to look at all your emails, they will be able to look at all of the information in the back end. That doesn't mean that your IP is, free and there's no privacy, but have the mindset that, you're going to need to stand by what you do and what you did. And it's also something that I often tell my first year analysts is every slide you deliver, assume that's your resume, right? So anything you turn in, realize that might be the first and only impression that the receiver ever gets of you. And so make sure you're comfortable with what you deliver and what you're doing.
Yeah. Different topic. Do you have any trends or a point of view on automated or autonomous financial services, especially those that are enabled by artificial intelligence or machine learning or other technologies?
Yes, love this one. So AI, machine learning, automation, and financial services. I think part of commoditization means that you can do automation. It means that, one of the concepts that we wrote in here is about, what is it called? You're selling, basically it's algorithmic purchasers. So to a certain extent, you're going to have more and more people that are non-humans buying things for non-emotional reasons. So it's going to be pure rationality. And so as these systems become more interconnected, as you have more open banking, as you have more digitized interactions, you're going to have more opportunity for like hard numbers based decision making, right? What's the fit for purpose item or way to do it? And so I think you're going to have more and more around that, but it's going to be more on the back end. Right, it's going to be all the systems and the plumbing that happens underneath. And so one of the buzzwords and one of the investment areas around that is kind of acquirer orchestration and orchestration in general in the back end in financial services. So, and the example I'll kind of give of that is when you swipe your card at a point of sale terminal, there's basically just like an Excel table lookup that routes your transaction there. That's static. So that's a huge opportunity to apply insight, intelligence, automation, or whatever you want to call it, to make that dynamic, right? To say like, oh, this person is purchasing a large ticket amount in a foreign currency in so-and-so at this circumstances. So maybe this transaction should flow over a different route and go over a different path in the back end. That's what I think that looks like, right? I think that's where you're going to start to see it first and foremost. And then outside of that, there's all the sexiness around personal financial managements, PFMs, all of this like optimize my money for me. I don't want to worry about it. Things like you start to see in a bit of the 401ks where they're optimizing for your retirement date, not your age and income. They're just saying like, okay, you're going to retire in 30 years. So we're going to adjust your risk factor and your investments based on that. And so that's where we start to see it already happening from a more consumer facing side.
Hmm. We're just going to take these last two questions that are already in the Q&A. Second to last question, could you talk a little bit more about promising new forms of funding a startup? Right up your alley, Griffey.
Oh boy. Promising new forms to fund your startup. That is a really, really good question. I mean, I don't have a great answer because I'm a crypto minimalist. So, 2 years ago, everybody would have been like, well, obviously an initial coin offering is the new fun, fast way to raise money for your startup. And then you can do rolling raises and you can do, you can turn it into equity or not. You can kind of be very dynamic around it. I think there is something there, but I also think that that doesn't really put you into the kind of the shortcoming of that is that you don't end up in the larger funding ecosystem. And the VC ecosystem is a very, very tight knit, very herd-like area. So once you're in, it can be very, very helpful and it can kind of really create a lot of momentum. So it's kind of like if you can get into the traditional, especially for the really early stages, if you can get into the traditional, you can get into the VC ecosystem, it can be really beneficial. So maybe your first stage is friends and family, bootstrapping, then it's angels. Hopefully your angels can bring you into family offices. Family offices can lead into venture capital. Venture capital can lead into private equity, and that can lead you into the IPO space. But that doesn't mean that you can't augment it also by something a little bit more, should we say, exotic, like an ICO, as long as it doesn't damage your brand or distract your management or your investors from kind of what you're trying to do, because you don't want your managing your shares to take up more time than actually building the company. That's sort of my strange answer to that question.
Great. The last question is a really nice kind of overall perspective from you. If you had to pick 2 trends to act on right now, what would they be?
Ooh, well, definitely open banking. I think that's number one. I think that's tempered by where do you live or where do you choose to act on. If you're in Europe, it's very, very much an act now, or you might have even actually missed some of that boat. If you're in other places, like you're in kind of North America, you're in the act now space, right? Fed just announced, Fed now. If you're in Latin America, you're starting to see a lot of regulators mandate open banking. If you're in the UK, it's also mandated. If you're in parts of Asia and Asia Pacific and Middle East and Africa, a lot of these mandates are hitting. And so that's an act now, and an act now in a sense of act now on what you can do with all this new data that's flooding the market, right? It's maybe less on the right, it's more on the read component than the write component, or writing, or like initiating transactions, so to speak. But there's so much richness that's about to hit, and transaction data that's about to hit the market and hit the ecosystem. So that's somewhere to be very well prepared for and kind of pick off the people who are starting to have progress and starting to accelerate there. A component of that's also like account to account payments and real-time payments and sort of all of those elements. I think that's one really, really big one for the open banking space. I think, and then I think there's another component of just that sort of invisible banking commoditization space. That example of like acquire orchestration, where you're getting really close to the act now. There's a lot of watch now, but there's also a lot of act now starting to happen, where it's, I want to connect multiple endpoints, right? The tagline for Visa and MasterCard is they want to be the network of networks, right? So Visa and MasterCard are talking about being the networks of networks. That means that there's a lot of networks that are big enough that something like Visa and MasterCard wants to connect to them and connect those different ecosystems. So I think there's a lot of that orchestration that's really hitting the ground running now from the back end side. If I wanted to say trends for connecting a little bit more on the consumer side, I think you're seeing a lot of the contactless Apple Pay coming to fruition and all those user experiences. So it's a little bit of that sort of card on file platform scale perspective is where you're seeing a lot of the act now. And I'll leave all the DeFi stuff for tomorrow.
Yeah, we'll cover it then and dive in. That was all the questions that we had.
Perfect. Wonderful. Well, I hope this was fun. I hope it was helpful. I really enjoyed the questions. And yeah, looking forward to our conversations tomorrow.
Thanks, everyone. Have a great day.